This is the Clear Money Talk podcast, offering up creative solutions for your retirement future through education, choice, transparency, and empathy. Now, your host, CEO and founder of Clear Financial Partners, Tim Clairmont, and co-host, Tyler Andrews.
Hello, and welcome to Clear Money Talk. I am your host, Tim Clairmont, CEO and founder of Clear Financial Partners, and with me, as always, our co-host, Mr. Tyler Andrews.
Thank you, Tim. We're in the podcast studio, recording another podcast. It's a sunny day in Oregon today. I don't know if you can see the lights shining on our face, but this is a nice change up for January in Oregon, specifically the Pacific Northwest. So we're accepting the sun, we're enjoying it, and we're ready to record a podcast for you guys.
Yeah, it's been gorgeous out this last couple of days. So by the time you're listening to this, I mean, who knows? You might be listening to it and be like, "You guys are liars! It's raining right now." But that is what it is. Today it's sunny. It's great.
Yep.
And if you're watching us on the YouTube channel, you actually get to see our faces, so you can see the light that Tyler was talking about. Anyway,
right.
Let's jump in. What are
Let's
we answering
do it.
today? What's our clear money talk question?
As normal, Tim doesn't know the topic. We love doing that. Keeps it fresh, keeps it funky. I just came up with the topic like 20 minutes ago, so it's still somewhat fresh for me too. So
Great.
we're gonna riff it and see what we come up with. Okay, today's topic of the day: independent versus corporate. Who should you trust with your financial future?
Ooh, interesting. Independent versus corporate. Okay.
There's so many different relationships you can establish, especially when working with financial advisors, financial planners, wealth advisors, all different terms for people that help you with your financial future and your current financial status. And there's different avenues that these professionals work in. Some of them work in wirehouses, banks, large corporate structures, and some advisors are independent, like Clear Financial Partners, Tim and myself. We're independent. We're not quote-unquote captive agents where we're being told what to do and how to do it. We have boundaries on what we can and can't do, obviously for good purposes, but we have the freedom to do what is in our client's best interest at any given time, which might not always be the case depending on who you're working with in the corporate structure for where they're at. So I thought it'd be fun to talk about the differences about this stuff. I don't think the general public probably realizes that there's different structures for this stuff, the pros, the cons, who might make sense for you to work with, and I thought we can just go through some of that stuff today and give clarity on how we do stuff, give clarity on how maybe other people do stuff, and maybe it'll make it more clear for the listeners on who they might want to consider working with when they're ready for it.
Yeah, I'm trying to take a step back and look at this as objectively as possible. Obviously, Tyler and I are we have a pretty strong opinion. We like the structure in which we currently get to work. We get to work in that independent capacity. But let me just kind of take a step back and why somebody might choose a corporation and working with a corporate advisor instead. And I think what we've noticed is that familiarity and confidence and trust that you might already have with a corporation. So, for example, you might go into your bank or you might be aware of a big brand name, and because of the name and your familiarity with it and or your comfortability with that bank or that corporation, you feel like you trust that company. And because you trust that company, you might feel like you want to work with them as far as managing your financial accounts. I get that, totally get that. That makes sense. I mean, that's the benefit of that rapid trust effect that you can have with a company that may have an excellent reputation. But I guess one of the other things is when you do have a company like that, as Tyler was saying, the company can have its own priorities that it imposes upon its employees. And with that in mind, that can trickle down into the advice that you receive. So the advice you receive may seem objective. It may seem as if you have lots of choices, but in reality, you may have a much more limited selection. For example, there are certain companies that sell what are called proprietary products. So the company itself creates the product that they want to sell you, and you can only buy that product through them. Usually their profit margins are higher on the product they create themselves. They make more money that way, and it creates a conflict of interest. It creates a desire for that company to sell their product instead of selling you a different company's product, which might have been better for you, might be a lower cost, and that conflict of interest can create an internal challenge. So it's just something to be aware of as you look at what your options are and the kind of advice that you're receiving. Anytime you go into a company and you work with them as a financial advisor or as your financial advisor, and they recommend a product from that same company, I would just encourage you to take an extra level of scrutiny on that product and really look at it and see, does that particular product really achieve what you want to achieve from a goal standpoint? Is it really the best choice for you from a pricing standpoint? And does the advisor you're working with have the breadth of available options as far as other alternatives? Those are the kinds of questions that you can look at. What are the other choices that they're considering, and what are those costs, and what are those benefits? And asking for that clarity will give you a little bit more insight into what that might look like. As an independent financial advisor, when you work with an independent advisor, they're able to work primarily with pretty much everything that's out there, with the exception of those proprietary products. So everything that's not proprietary, which probably represents 85 to 95% of the products available on the market, and that could include mutual funds, stocks, bonds, anything that you go into a custodial or brokerage account and you make investment choices in any of those individual securities options. Those are usually flexible enough for you to make your own decisions, but you got to decide what works for you, and who do you like to work with, who do you click with, and what do you prioritize? What's the most important thing to you? Is it fees? Is it breadth of product offerings? Is it benefits on the products? Is it the relationship with the financial advisor? Some people, the relationship itself is the most important thing to them, and if you click with the relationship and you don't want to mess with that. Having a good relationship could be the most important thing, and then everything else, you might be willing to accept certain aspects that might not be ideal for you because you prioritize the relationship over the product selection or the investment options that you might have available. On the other hand, if you prioritize your investment options and your fees above the relationship, and you haven't analyzed those yet, then you should take a good look at them. Make sure that you're really choosing the best investment choices and have the right fee structure that makes the most sense given your circumstances.
Yeah, I thought all those were super insightful, and I appreciate you taking that step back, talking about all that stuff. So thank you for that. A lot of that stuff I hadn't even thought of as we were going through this. So that's awesome, and I think that brings up a good point. Depending on the firm where your advisor might work, or the firm that you might be interested in working with, they have different priorities, right? Some firms might be more in the avenue in the business of insurance. Some might be more in the avenue in the business of just managing assets, large money manager. Some might be in the business of more of a holistic financial planning approach where they're tackling everything in kind of a one-stop shop place. And I think depending on your needs, as Tim was saying, will kind of dictate which of those makes the most sense for you as an investor, as somebody trying to find the right person to partner with on your financial planning and your financial future. I can say that at Clear Financial Partners, we don't just manage money. We build you basically a strategy for your entire life. That's the holistic approach, really. And yeah.
No, you're spot on. I appreciate you bringing that up too, Tyler. That's a good clarification. As an independent advisor or a corporate advisor, whomever you choose to work with, it's good to be aware of the limitations on what they do and what they don't do. And just be very clear in your communication up front with whomever you're working with to understand what do you do and what do you not do? And there's a great checklist that you can go through that helps you identify what are all the different things that your financial advisor may or may not be able to help you with. That checklist is what we refer to as the 5 principles of financial planning, or the 5 tenets of financial planning.
Nice.
And
I knew you were going to go this route.
It makes sense.
It does make perfect sense.
So we'll talk about that as a checklist, so you can learn what they do and what they don't do, and then we'll also talk about products, because there are 5 different types of products or investments that we work with, and we've assigned colors to those too. So I'll cover both of those with you real quick. The 5 and feel free to take notes. Obviously, that's one of the benefits of this stuff, right? Write this stuff down, pause it, rewind it, whatever you need to do to get the information you need. We're about giving you this information, this education, and we hope that it adds value for you in your life. But the 5 principles of financial planning, the first one is rate of return. Are you getting a good rate of return on your accounts? Now, most financial advisors are going to handle that particular responsibility. They're going to manage your portfolio to try to optimize rate of return, or at least they're going to accept the responsibility of helping you manage that portfolio to optimize rate of return. That's like table stakes for most financial advisors. That's the first of the 5 principles. The second is retirement income planning. And here is where you start to see some deviation. Some advisors don't do retirement income planning. They're just doing money management. And they're not giving consideration to how much income are you going to need when you retire, what are your tax ramifications on all of that retirement income as it comes in over your lifetime in your retirement, what are your legacy desires and your implications as far as leaving money behind after retirement. All of that ties into retirement income planning. And that's where you'll start to see some advisors fall off. There are many advisors that just don't do that. They're going to manage the money and that's it. And if all they do is manage the money, obviously that expense structure is likely to be lower than an advisor who does everything for you, who does retirement income planning as well as managing the money. We do both. We do handle retirement income planning and managing the money for our clients. So we cover the first 2 of the 5 principles of financial planning. The third principle is estate planning. This is where you work with an attorney typically to handle all your legal documents, wills, advance directives, durable power of attorneys, trusts, all of that kind of stuff. We're not attorneys, so that's an area where we don't do that, but we work with other attorneys to get that done. So if you've got a great attorney, wonderful. They're like a player on your football team. Think of us as the quarterback, and maybe they're the wide receiver. We're going to throw the ball out to them, and we're going to make sure they do a good job. So we're going to watch that attorney and make sure that we work together and cooperate together so that we can achieve your goals, but we don't draft the legal documents. The fourth principle is tax planning, which we do get involved there when it comes to the retirement income planning part, but we are not tax preparers. So we don't prepare our clients' tax returns, and we don't defend them in an audit with the IRS. You'll need your accountant to handle that, but we definitely work very closely with the accountant as if they're another player on your team, maybe a blocker. And their role is to help you make sure you're filing things correctly with the IRS and maybe the state revenue department, depending on which state you might be located in. Potentially the city revenue department, depending on which city you're located in. That's the nature of income taxes at this time. But all of those different taxes get factored in and get considered when we design your retirement income planning or any other planning structures. The fifth principle is protection planning, and it breaks into 3 subcategories. The first 2 we don't handle in-house. That's health insurance and auto and home insurance. We like to make sure you're adequately covered, obviously, in those areas, and we'll address those with you and make sure you have great players. Again, maybe that's like a specialty player, like a kicker on your team or something along those lines that does the things we don't do. But we do handle the third bullet of the 5th principle, which is life insurance, long-term care insurance, and long-term disability insurance. So anything related to life insurance or long-term care or long-term disability insurance is in our wheelhouse. We can handle that for you. Think of that like maybe the quarterback is doing a quarterback sneak, right? In this scenario, it's like the regular stuff we do, retirement income planning, managing, that's throwing the ball, being the quarterback, doing the thing. But the life insurance, long-term care insurance, long-term disability insurance, sometimes we got to run the ball, and we'll try to get it into the end zone for you. But that's the 5 principles of financial planning, and just making sure that you understand what your advisor does and doesn't do will help you to better ascertain whether or not everything is being covered, which is the most important thing. And then also, that your compensation or your cost, your fees associated with that is appropriate for the services you're receiving. That's the 5 principles of financial planning. Before I transition to the 5 products and the colors, anything you want to add to that, Tyler?
I like the football analogy, man. Yeah. That was cool. That was good.
Yeah, it feels good. Well, the clients are either the coach or the owner. Sometimes they're the coach, because they get to coach the whole team and they get more involved.
I mean, at the end of the day, they get to make the final call.
That's
with
right.
Everything. I mean,
Absolutely.
The quarterback doesn't. The quarterback, has their playlist of things to recommend and talk about. But at the end of the day, it's the coach that's saying, this is the play we're running, go.
Yep.
And the quarterback can say, no, I'm not going to do that. And they can, trade to a different team or whatever. But, every player on the field is replaceable.
Yep.
The coach, I guess, is replaceable too at the end of the day. But they get to decide who's on the field.
Yeah. So with this analogy, one of the things I've discovered, in the past as I kind of think through this, because I feel like the analogy sticks. I'm not a big sports guy, by the way. If you ever meet me, it's like I'm not a big sports guy. I don't watch a lot.
That's why I was like, that was cool.
But,
yeah, good work.
But I do feel like it's an excellent analogy. It works, and I have discovered and been told I am a conference guy. I love to learn and just be a nerd for learning new things. I was at a conference and I was listening to an amazing speaker, and they explained that there's 3 types of people in the world. Do-it-yourselfers, collaborators, and delegators. And do-it-yourselfers obviously just do everything themselves. Collaborators work together with professionals to get things done. And then delegators, they just say, take care of it for me. And we work very, very well with the collaborators and the delegators. See, the collaborator is like a coach. So if you're a coach, if you're a collaborator, you're the coach, you're working together with me as the quarterback and Tyler, and we're working together with the rest of the team and making sure that the plays go exactly the way you want them. And we talk through everything and we work together, and ultimately we perform for you. You're our coach. When you're a delegator, you're more like the owner. You're the owner of the team, and you're asking us to step in as not just the quarterback, but also kind of like the coach. And in that scenario, we're coaching the team, and we're also running the quarterback role and handling everything for you. And we just need to inform you of everything critical that you need to be aware of as more of a delegator. So you can either be that coach or that owner. The do-it-yourselfer is a person who's like, hey, I want to be the owner or the coach, and I'm going to go run the ball myself. I'm going to throw the ball myself. I'm going to be the quarterback. I'm going to manage my own money. And that's fine if you're a do-it-yourselfer and you want to handle it, as long as you can do a great job. I mean, if you're a great quarterback and you can handle all that stuff, that's wonderful. But it's really hard to compete when we've been doing this for 27 years now. It'd be like, just going out to an open tryout and trying to give it a shot against rock star people that have been throwing that ball for 27 years. And in this case, you don't age out like you can in some of the sports stuff. If anything, the more years of experience you have, the more wisdom and knowledge you can bring to bear on throwing that ball. So, but it's a little additional insight into where your role might fit working with your financial advisor.
Well said. I like it. Do you want to go into the 5 colors?
Yeah.
Talk about those. I think that's
as an independent
segue
versus corporate. Let's talk about that. So as an independent advisor and or a corporate advisor, you're likely to come across these 5 product types. And some advisors, both as independents and as corporate advisors, only work with some of these color product types. So the 5 colors are, and again, feel free to take notes: blue, red, yellow, green, and orange. Blue is your managed money, stocks, bonds, ETFs, mutual funds, liquid accounts that are just invested. Pretty much most financial advisors that I know handle blue. They do blue accounts. It's just investment accounts. Now, some advisors believe that that's the only kind of account you can go with because they don't do the other 4 colors. And in that kind of a scenario, you have to understand that person has a conflict of interest because they don't work with the other products. And so they're naturally inclined to tell you the other products are bad because they want you to do everything with them in blue. So understand, the more limited options that your advisor has, the more likely you're going to encounter conflict of interest and biased opinions about how to invest your money because they don't have access to some of the other things that you could be doing. Red is what's called a fixed indexed annuity, and yellow is a variable annuity. Many of the people that manage blue don't want to deal with the complications of understanding red and yellow, so they'd rather just tell you they're bad. Don't go there. Let's just do everything in blue. Most of the time I find that, some of them are not great, but some of them are pretty amazing, and a lot of them are somewhere in between. So I just think that finding the amazing ones and making that available to my clients, if that's what they want, is better than just saying they're all bad. Green is life insurance. That's when you work with life insurance strategies. There's a lot of neat ways you can work with life insurance, both protection-oriented or income-oriented. Most people are familiar with protection-oriented. Fewer people are aware of income-oriented. Feel free to check out some of our previous podcasts about the LARP, for example, life insurance retirement plan. Those kinds of podcasts are all talking about using green to create income. And then the last option, orange, is alternative investments, where you might have something that you want to do where you sell rental property or commercial real estate, and you want to transfer that in a tax-advantaged way through something called a 1031 exchange into partial ownership of apartment complexes or other kinds of investments. We have access to things called DSTs, Delaware Statutory Trusts, that we categorize as orange. We also have other alternative investments that are maybe not available through the traditional channels of blue, let alone red, yellow, or green. So there's your orange options. And we work with all 5 of those. And we find that some of our clients will want all of one color and other clients want all of a different color. And most of our clients actually like sort of a rainbow approach. They see the value in all the colors, and we lean into what makes the most sense given their circumstances.
Well said, like normal. Yeah, that's something, the colors is something Tim came up with probably a couple years ago now. And it just helps to take complex ideas and put them into an easy to remember format. You're not going to really hear the colors anywhere else. So if you do, they probably ripped it off from us. And
that's right.
You should go to the source and call us.
It is clear money talk. We're trying to be cleared as when we talk about money for you. And the colors are something I came up with because I felt like it just made things clearer. So let's keep it simple.
Yeah.
Keep it simple.
I'm thinking in my head as you're talking, as we're going through this, that knowledge is power, right? And It bugs me when people don't know what they don't know, and they don't know what questions to ask and what not to ask, and they get partnered up with an advisor that is missing things for them, and we see it all too common. And the client, maybe you didn't know what you were missing out on, and some of these advisors take a fear-based tactic approach to saying, "Oh, I don't do that color, or I don't do that investment. I only do this one." And if someone's recommending that other thing to you, it's bad. They shouldn't be doing that. And that's not the approach we like. You should be able to take a very transparent, education-based approach to any type of investments. Investments exist for a reason. They have a place, maybe not for everybody, but in certain circumstances. And if someone's telling you that, "Oh, we just don't do that," that's a little bit of a flag for me.
Yeah, it's a big flag for me. We think about it. Why would an investment exist and be so prevalent as these 5 colors are, if there wasn't somebody that it made sense for?
Correct.
So anybody that tells you those are bad, just blanket, is really just trying to oversimplify their circumstances, because they probably don't understand it or they don't work with it, or both. And that's it is what it is. Just good conflict of interest to be aware of.
Yeah.
Gosh, there was something else. Oh, back to the football analogy.
Yeah.
When you're doing what you said really triggered this for me, Tyler, which is great. You said a lot of people don't know what they don't know, and you're absolutely right. If you're more of a do-it-yourselfer and not so much a collaborator, what you're basically doing is you're the quarterback, right? You're managing your own money. You're handling all the 5 principles of financial planning to whatever degree you can. You're being responsible for all of it. And you might be out there alone on the field, throwing the ball to yourself, trying to catch it, trying to kick it yourself through the field goals, and also trying to run it whenever you need to run it into the end zone. And you don't have any other players on your team. And you can just accomplish so much more with professionals that are experts in these various categories. And so I don't know who's on your team or what your team looks like, but if you find yourself playing all the positions, that's exhausting and usually not as successful. So just be aware of that.
Yeah. That's all I got.
Yeah.
I just feel like we could keep going down all these different avenues. I could talk about this topic for a long time. And I don't think that's in the best interest.
No,
of the podcast.
I agree. Good luck. So, I'm gonna pivot and I'll let you do just the answer as usual. So
I would love to
wrap it up.
Okay,
us, Tyler. What do you got?
For just the answer, again, to repeat our topic of the day, it was independent versus corporate. Who should you trust with your financial future? The answer is it's going to depend. It's going to depend on you and what you're looking for, what your financial situation looks like, what you want your financial situation to look like, what you look for in partnering with other professionals in your lives, whether it's your financial planner, your lawyer, your CPA, or anybody else that you work collaboratively with. Is important for those regards. Some of the topics that and concepts that Tim and I talked about was independent is advisors, specifically talking, because that's what we do, is talking about having a large breadth of investment options, so that way you're not just pinned to one or two things that maybe a different entity or structure for advisors might allocate your investments to. Another thing was making sure that you're working through the 5 principles of financial planning, the rate of return investment planning, the retirement income planning, the estate planning, the tax planning, and the insurance planning, making sure that who you're partnering with, at a minimum, at least mentions all 5 of those things to you at some point, whether they do it in-house or whether they outsource it to somebody else, like a CPA or an estate planning attorney. At least if they mention it to you, that means they're keeping track of it. If your advisor that you've been working with has never mentioned at least all those things to you at least once, they're not even thinking about it. And they're just saying, that's up to you to think about. I'm just going to focus on managing your assets over here, and that's it. Well, is that really a holistic, well-rounded financial plan? Maybe, but probably not. And, in those situations, you might want to call Clear Financial Partners. But anyways, I digress. And we also talked about the 5 colors, where we talked about Tim assigns a different color to different investment options that exist out there. And if some of those colors, you're like, what is that? I've never heard about that. My advisor's never mentioned that to me before. Maybe another reason to give somebody a call that does all those 5 colors, and you can see whether it makes sense for you or if it doesn't make sense for you. So that's kind of the bullet answer on what we talked about. And, I just think that holistic financial planning is more than just managing money. It's really creating a customized long-term strategy for you. And, we see time and time again that is one of the most proven ways to create financial success for the short term and long term is by making sure everything is, no stone is unturned, essentially.
Yep. No, it's well summarized, Tyler.
Did I miss anything?
The only thing just back to the specific question itself, independent versus corporate.
Yeah.
I would just say from the just the answer standpoint, independents generally have access to a wider breadth of product options, but corporations have the benefit of the reputation associated with the name of the corporation.
Yeah.
And if you trust the name of that corporation, and that's a really, really important element to you, that's okay. Just be aware that they may have a limited selection of products. And if you are invested in what's called a proprietary product, meaning something that only that corporation has available, be extra aware of the risks associated with that conflict of interest, because most of the proprietary products that we've seen out there tend to be more expensive than what's otherwise available on the market, and usually not as advantageous. But they are very profitable for the corporations. So that conflict of interest is inherent in proprietary products, and it's just worth double checking that before you decide to invest in one.
Yeah.
We good?
I like it.
All
We're
right.
good.
Let's move on to
You
trivia.
ready for some trivia, man? All right. Let's go. All
right, what do you got?
In the Marvel Cinematic Universe, which superhero is famously known for saying, "I can do this all day"? I can do this all day.
I can do this all day. I know I've heard it in the
I can give you some
Marvel
options. I'm prepared to give you some choices.
Let me noodle on it.
I always
just
want to
for
give
a
you an
sec.
option to Hail Mary it, see if you can just come up with it yourself.
This all day. Gosh, man. I feel like, I could see Thor doing that, but I don't feel like that's the right answer. I feel like it's somebody that's a little bit snarkier. More like I could see Iron Man maybe saying that. I could also see what's his name? Deadpool. I could see Deadpool saying that. So, but because they have that snarky thing going on. But no, honestly, I can't pick one definitively. So I'm gonna have to go with multiple choice. What do you got for me? What do you got for me?
Option A is Iron Man.
Okay.
Option B is Captain America. Option C is Thor. And option D is Spider-Man.
Oh, okay. I don't think it's Spider-Man. I'm pretty sure Spider-Man doesn't say that. So I'm going to eliminate that one. And then I'm pretty sure it might be Thor. I had that. That was my initial gut check. Sometimes you got to go with your gut check because that's usually on point.
Yeah.
Captain America, though, I now that you mention it, I feel like that's the right answer. I feel like I remember him saying I could do this all day. And that it just makes me smile a little bit. So I'm going to just go with Captain America.
You got it. Nice work.
Nice. Oh, that's good. But yeah, Iron Man and Thor were both in there too. So I could easily see them saying along those same lines too. But Captain America.
Nice work, man.
All right.
Good.
Yeah. Sometimes POE, process of elimination.
I was going to say,
we
good
learned
work.
all that in high school.
Going through it one at a time. Eliminate. You get down to 2. You got a 50-50 chance.
That's
And
right.
That's always my approach too.
Why we like choice. So
Yes.
By having lots of choices, you can decide between the choices what you want to go with. So
Yeah, and that brings us to a nice natural close here of the podcast is that thanks for tuning in. You deserve more than a cookie cutter approach to your financial future. So, team up with somebody that you feel good about that is covering all those bases that we talked about earlier. And if you don't have somebody and you're interested in talking to us, you can give us a call, send us an email, check out our website. There's plenty of other podcasts you can continue learning from. And we just want to make sure that you guys are empowered in your financial journeys. That's why we do what we do.
Excellent stuff. Thank you so much for your time. As always, we appreciate your minutes and have a wonderful, wonderful rest of your day.
Tim Clairmont and Tyler Andrews are investment advisor representatives offering securities and advisory services through Cetera Advisor Networks, LLC, a broker-dealer and registered investment advisor, member FINRA SIPC. Cetera is under separate ownership from any other named entity. The views depicted in this material are for information purposes only and are not necessarily those of Cetera Advisor Networks, LLC. They should not be considered specific advice or recommendations for any individual. For a comprehensive review of your personal situation, always consult with a tax or legal advisor. Neither Cetera Advisor Network, LLC, nor any of its representatives may give legal or tax advice. All investing involves risk, including the possible loss of principal. There is no assurance that any investment strategy will be successful. Examples referenced are hypothetical only and do not represent the actual performance of any particular investments. Distributions from traditional IRAs and employer-sponsored retirement plans are taxed as ordinary income, and if taken prior to reaching age 59.5, may be subject to an additional 10% IRS tax penalty. Investors should consider the investment objectives, risks and charges, and expenses of mutual funds and ETFs carefully before investing. The prospectus, which contains this and other information about the funds and ETFs can be obtained directly from the company or from your financial professional. The prospectus should be read carefully before investing or sending money. A diversified portfolio does not assure a profit or protect against loss in a declining market. Dollar cost averaging will not guarantee a profit or protect you from loss, but may reduce your average cost per share in a fluctuating market. Investors cannot invest directly in indexes. The performance of any index is not indicative of the performance of any investment and does not take into account the effects of inflation and the fees and expenses associated with investing. Although it is possible to have guaranteed income for life with a fixed annuity, there is no assurance that this income will keep up with inflation. There is a surrender charge imposed generally during the first 5 to 7 years or during the rate guarantee period. There is a surrender charge imposed generally during the first 5 to 7 years that you own the contract. Withdrawals prior to age 59.5 may result in a 10% IRS tax penalty, in addition to any ordinary income tax. The guarantee of the annuity is backed by the financial strength of the underlying insurance company. Investment subaccount values will fluctuate with changes in market conditions. An investment in a variable annuity involves investment risk, including possible loss of principal. Variable annuities are designed for long-term investing. The contract, when redeemed, may be worth more or less than the total amount invested. Variable annuities are subject to insurance-related charges, including mortality and expense charges, administrative fees, and the expenses associated with the underlying subaccounts. Investors should consider the investment objectives, risks, and charges and expenses of the variable annuity carefully before investing. The prospectus contains this and other information about the variable annuity. Contact Clear Financial Partners at info@clearfp.com or 503-579-1000 to obtain a prospectus, which should be read carefully before investing or sending money. The cost and availability of life insurance depend on factors such as age, health, and the type and amount of insurance purchased. Before implementing a strategy involving life insurance, it would be prudent to make sure that you are insurable by having the policy approved. As with most financial decisions, there are expenses associated with the purchase of life insurance. Policies commonly have mortality and expense charges. In addition, if a policy is surrendered prematurely, there may be surrender charges and income tax implications. Clear Financial Partners is located at 15573 Bangor Road, Suite 100, Lake Oswego, Oregon, 97035. For more information, please call us at 503-579-1000.